Toolbox seminar this morning. 2017, the tax grab, one might give it as a subtitle. I'm reminded of an old joke, an old story. A little boy really wanted $100 very much, and so he waited and prayed and waited. Finally, he decided to write a letter to God asking for the money. When Canada Post saw the letter addressed to God Canada, they sent it to the Prime Minister. Well, Justin Trudeau was very pleased and amused to receive it, and he instructed his secretary to send the little boy $5, which he thought, oh, the little boy would consider that to be a substantial amount of money. So the little boy received the money, and he was delighted, and he decided he would write a thank you letter to God. And here's how it read. Dear God, thank you very much for the money, but I see that you sent it through Ottawa, and the son of a gun deducted $95 in taxes. So today's seminar is going to be devoted entirely to taxes. And the three speakers are from our tax group. Our first speaker is going to be Bill Bernstein. Bill is a partner in our tax group who specializes particularly in private companies, estate planning, and so on. And he's going to be talking about the new rules on income splitting, the sprinkling, and so on. Trying to understand the rules, and maybe we can give you some guidelines on what happens if these things are enacted. Our second speaker is Josh Harnett. He's our senior associate in the tax group, who also is very involved on a regular basis in private company and entrepreneurial planning. He's going to be talking about the lifetime capital gains exemption, the restrictions that are being proposed, the limitations, and so on, and the anti-avoidance rules in trying to prevent what the government would purport to be abusive conversion of ordinary income into capital gains. And then I'll be speaking about the new taxation of passive investments in private companies, and a little bit of a potpourri of things. I'll talk about the new voluntary disclosure rules, tightening those as well. And finally, the automatic exchange of information rules that Canada's bringing in that affect not only the large companies, but also individuals and smaller ones as well that we may not all be aware of. We welcome comments and questions. We'll be here afterwards. If you'd like to stay and ask us, we'd be happy to answer them. And you've all got little programs, but there are also evaluation sheets, which we'd ask you please to fill out so you can help us with understanding how to make it better and come up with new topics for the next seminar that we've got. So without any further ado, Bill, up with you.
Good morning, everybody. Hopefully this mic is working well. I'm going to be speaking about the proposed changes that relate primarily to private company income splitting, so they have very broad application. These are not some of the esoteric tax changes that apply only in very limited situations. These apply very broadly. I think I'm having a technical problem. Okay. So just for starters, to review the issues that I'm going to be discussing today. Firstly, I'll discuss some of the background to the proposed changes. I'll briefly review the current rules that apply relating to income splitting with Canadian-controlled private corporations. Then I'll get into the actual proposed changes for income splitting with CCPCs. I don't know, I think most of the tax community tends to use the term income splitting The government seems to prefer income sprinkling, but it's basically the same thing. There's a few aspects of the changes. Firstly, the individuals to whom these restrictions will apply has been expanded. The types of income that will be subject to this restriction will be expanded, and I'll review some of the exemptions from the new restrictions. Then I'll consider some planning issues as to what we have been doing that will no longer work or will be restricted, what type of planning is still available, and what can or should be done before the end of the year, and then briefly review some of the takeaways. So in terms of the background, I mean, these changes were announced in detail with some draft legislation, explanatory notes, and a very detailed consultation paper that was released July 18. The general concept shouldn't have come as a total surprise because the government did make some general noise in the federal budget for 2017 that they were looking into announcing some restrictions relating to private corporations. They indicated they generally thought there was some unfairness and that, of course, they seem to have turned this into a real political issue of challenging the wealthy people because the poor small guy in the middle class are paying too much tax, and the rich people are getting away with murder with some of these tax breaks and that. So, I mean, that seems to be the general thrust of these tax changes. And I think even though we were warned about the likely changes, I think the tax community, it's fair to say, was definitely surprised by the significance of the changes, how extreme and how broad-based they are. So these changes are very, very major and make, just huge changes to what's been the commonly accepted system for taxing private corporations, their shareholders and family members. Again, the government politically often makes noise about not liking the fact that rich professionals make use of private corporations through professional corporations or generally wealthy individuals. But these changes are totally broad-based. They're not focused at all in terms of any particular types of private corporations. They basically apply to every single private corporation. And that's why, I mean, you've seen in the news, even within the Liberal Party itself, they're not happy with these changes because you can be sure the average small business person who has a private corporation is very concerned about these. And this is not really part of the government's message. It's like, they're there to help the little guy, the middle class, and they're going after the wealthy. Well, that's not what these changes are restricted to do. The other thing that makes it fairly clear that this is primarily a political issue, even based on the government projections, the amount of additional tax that's going to be collected from the proposed income splitting changes is very, very minor. So that the significance of the changes cannot really be justified based on the amount of revenue that the government thinks is being lost by these various tax breaks. So one issue that I'm somewhat hopeful about is that while these changes are very broad and can be very, very, extreme, that at least on the income splitting side, that I have some hope that despite all the noise, once they're in force, the government CRA will not be that aggressive in challenging, common situations like dividends, but of course, that remains to be seen. The different issues that are targeted in these July 18 proposals are firstly the income sprinkling, which I'll be dealing with, restrictions to use of the lifetime capital gains exemption, which Josh will be talking about, and also issues relating to really challenging capital gains tax and converting into dividend income, which Josh will also be dealing with, and issues relating to holding passive investments in a private corporation that Lorne will be dealing with. Again, as I mentioned, the scope of these changes go well beyond what the tax community was expecting. These changes are going to affect basically all, or at least most, private corporations. The new rules relating to income splitting become effective as of January 1, 2018. So because of that, some of the changes became effective immediately as of July 18th. The government, at least for these income splitting changes, was reasonable enough not to bring them into effect till the beginning of next year. So there are some things that can be done this year. There has been huge opposition to these changes by different groups, even as I mentioned within the Liberal Party itself. There's been a lot of opposition, which I'm sure isn't what Trudeau and Morneau were hoping for. It's not what you want to see when your own party is complaining about the changes. And certainly one of the groups that's most offended by these changes are physicians, especially because a number of years ago, as part of their negotiations with the Ontario government, instead of giving them higher OHIP fees, they allowed to give them a break by having family members allowed as shareholders of professional corporations, which is not generally allowed. For example, lawyers, accountants, engineers are not allowed to have family members for income splitting. So the Ontario government specifically allowed income splitting for physicians. Now the federal government is taking that away. So not surprisingly, the physicians are not happy. Briefly to review the current rules relating to income splitting as they apply to CCPCs, two general types of restrictions. There's a series of attribution rules in the Income Tax Act that restrict income splitting with minors and spouses. Those rules are not being changed by these proposals. They'll still be there. The second type of restriction, which is the one that's being expanded by these proposals, is what's been referred to as the kiddie tax, and it has been limited to splitting income with minors. The effect of the kiddie tax, if it applies, is basically taxation at the top marginal rate, so it removes the tax advantages from income splitting. Another feature of our graduated tax system is that, and I mean, that's the reason why income splitting is, pursued in the first place, is because of our graduated tax system. So for example, within a family unit, the family can pay significantly less tax overall if the income is split between both parents and their children, rather than all being taxed to one parent. But because of the way the graduated tax system works, the advantages disappear at relatively low amounts. So sort of the maximum annual tax savings in the extreme situation of an individual who has zero other income is about $25,000 to $35,000 per year. So it's not insignificant, but it's not huge. And the tax savings decrease significantly if the family member has other income. One of the current types of income splitting commonly used is income splitting by dividends. Under the current rules, it is possible to split income by use of dividends with spouses and adult children. It is necessary to set up structures carefully because there are both personal and corporate attribution rules that can defeat that. So typical common tax planning in a private corporation would have a structure that would allow dividends to be paid to adult children and or a spouse, either owning shares directly or through a discretionary family trust that allows for more flexibility. It's interesting to note that CRA challenged this type of planning in the past quite aggressively, and there were a number of court cases dealing with it. The challenges went all the way to the Supreme Court, and the Supreme Court of Canada determined decisively that CRA was wrong, that it was totally legal to split income with dividends, and most importantly, that the right to split income with dividends was not dependent on whether the shareholder was actively involved in the business. Unlike paying a salary to a family member, dividends legally, you can receive dividends even if you do zero work, have contributed zero capital to a corporation. So CRA lost on that account. Basically, this proposed draft legislation is designed to override Supreme Court of Canada decisions. If you don't like the results, just change the rules. Another type of income splitting commonly used, which is not being changed by the July 18 proposals, is income splitting by salary. As I just mentioned, there's always been a restriction in the Income Tax Act that salary to family members is supposed to be limited to what's reasonable, relevant to the services provided on an arm's length test. Significantly, in the context of splitting by salary, there is a risk of double tax, because say if I paid a salary to my son of $40,000, CRA challenged it and said, your son doesn't do anything in the business. And the result of that under the Income Tax Act is to deny the corporation to claim a deduction. So in that situation, my son is going to be taxed on the salary, but my corporation doesn't get to claim a deduction. That results in double tax. Again, I'm not on the front line as an accountant, but my impression is that despite this restriction having been there basically more or less forever, CRA has not been overly aggressive in challenging salaries on this reasonableness test, so long as you don't push it too hard. I mean, my understanding is it's very common for accountants to pay salaries to family members, you know, $30,000, $40,000 a year, when if really scrutinized could be, you know, challenged by CRA. So a key issue, which is unknown on these new dividend restrictions, is how aggressive will CRA be in enforcing this new reasonableness test. So now getting into the nature of the proposed changes relating to income splitting, the first significant change is to expand the base of individuals for who the restriction will apply. And the term in the legislation is this going to apply to all specified individuals. This is a huge change. Up to now, as I mentioned, these restrictions were limited to what was the kiddie tax to individuals under the age of 18. Other key term used in the legislation, sort of the equivalent, what has been called the kiddie tax, is the tax on split income. And the key issue is that this tax, this restriction on income splitting, will now be expanded to apply to children over the age of 18 and other related individuals, including spouses, common law partners, and they've even gone to the extent of broadening the usual group by specifically including aunts, uncles, nieces, and nephews. So it's an extremely broad group of individuals who will be now subject to these restrictions. The restrictions are limited to individuals resident in Canada. The second major expansion to these rules is the type of income that will be subject to this tax on split income. In terms of the types of income that was not previously restricted, a key one is gains from property that would produce split income. So in particular, shares of a CCPC. So if you have a share that is sold, the capital gain from that share will automatically be taxed at the top marginal rate. And there's an even there's several more significant changes that relate to gains from shares. The next new item is that the capital gains exemption on those shares will be denied. So if I have a typical private company and either my wife and adult children own shares directly or through a family trust, and I sell my business through a share of sale, sell the business by way of sale of shares, my family members will no longer be able to claim the capital gains exemption. Josh will be dealing with this issue in more detail, but that's certainly been a common type of private company planning used that will no longer be available. Another key issue is that if the sale of shares is in a non-arm's length situation, instead of the gain being taxed as a capital gain, it's going to be taxed as a non-eligible dividend. And the common thrust of these changes is that under our tax system now, the way it has evolved, the tax rate on capital gains is much lower than the tax rate on individuals. So a number of the changes have the effect of converting what would otherwise be a capital gain into dividends, which results in higher tax. And it's interesting that prior to the last budget, there was a lot of speculation that CRA was going to increase the tax rate on capital gains, such as by making 3/4 of a gain taxable instead of 50%. They didn't go through with that change. Not that I would have been a fan of that change, but if they did make that change, then that would have eliminated most of the difference in the tax between capital gains and dividends and would have likely avoided the need for a number of these changes. So again, to the extent these changes are largely politically motivated, it seems the government must have considered the issue and figured politically increasing the capital gains tax would offend more people than these changes. Other types of income that will now be subject to the restrictions are income from loans to a corporation, so that if a family member loans money, the interest will be subject to the restrictions. Another restriction, it used to be that income on previously split income was not subject to the restrictions. That will no longer be the case for individuals under the age of 25, and also amounts included in income because of benefits conferred will also be subject to the restrictions. So in general, you can see that there'll be a lot more items that will be subject to the restrictions. From a practical point of view, a key issue is, well, what situations are exempt from these restrictions? There's two different sets of exemptions depending on whether an individual is age 25 or over. So the first exemption, so to speak, if you're over 25, is based on a reasonableness test. So it's adopting a test similar to the test that's always been there for salaries, but it's a little more specific in terms of listing issues to be considered as to what would be considered reasonable. So the first issue is assets contributed to the business. So for example, I mean, typically in a private company, shares are often issued for a nominal price, but in some situations, shares may be issued for a significant amount. So, I mean, that's one example where the shareholders contributed assets, so it would be reasonable to pay an arm's length dividend on those shares. The next item would be labor contributed. So if the individual is working in the business, that would be relevant to what's reasonable. And also an interesting issue that they mention is previous returns and remuneration. So this seems to suggest catch-up payments might be allowed, which is, you know, nice in theory, a relieving item, but again, it just adds to the uncertainty as to looking back historically what an individual has been paid out of the company as salary or dividends, and taking that into account in what's being paid to the individual on a go-forward basis. The government, obviously, based on the restrictions, decided that they feel there's more abuse for younger children. They weren't good enough to limit it to minors. There's stricter tests for individuals age 18 to 24. So in order to meet the reasonableness requirement for them, which again, these restrictions seem extremely unreasonable, is that in terms of working in the business, it's not good enough that your under 25 child is working part-time in the business. They only warranted to be paid dividends if they're working on a regular and continuous basis. Secondly, which seems to be relatively unlikely, if your child under 25 has loaned money to the business, the interest rate return would be limited to the very low prescribed rate, which is certainly less than you would pay in an arm's length situation. So they're certainly going even more strictly against individuals under age 25. A general problem with these restrictions and the reasonableness test is that naturally it's an inherently uncertain test. There's, basically people running businesses will have no idea as to what amount CRA is going to consider to be reasonable in any given situation. CRA has always already indicated that it's going to be, a question of fact in each situation. So it just throws up huge uncertainty as to what will be, considered acceptable tax planning in terms of income splitting. There's also a specific rule that would relate primarily to holding companies. So if you have a private corporation where more than 50% of the income is from property, or that's the main purpose of the business is to earn income from property, such as in the typical holding company, then the individual is automatically deemed to have not performed any labor function in respect of the business. So if you got a family member who's managing the investments, it seems that doesn't count and that doesn't warrant any type of dividends or other income, which again just is another of the many aspects that seem like they're going way too far. From a planning point of view, in terms of what's no longer available or will be restricted, certainly in the common situations where you're structuring shares either after an estate freeze or setting up a new corporation where the share structure typically is designed to allow flexibility for income splitting with family members, all those situations now are going to be subject to this new reasonableness test, which will create significant uncertainty. An item that's of less significance, but is still a nuisance factor, is this change of reinvestment of split income by a child under age 25. In terms of planning that is still available, again, the first item that I mentioned before that is not affected by these proposed changes are salaries to the extent that they're reasonable. And as I've indicated, this restriction has been around for forever, and CRA doesn't seem to have challenged it that aggressively if you don't push it too hard. In terms of dividends to children age 25 or over and spouses, there is still the ability to pay dividends based on the reasonableness standard, and also possibly to allow additional dividends on the basis of them being catch-up payments relative to prior years. Certainly in the estate freeze context, while there will be some restrictions on dividends, an estate freeze can still accomplish useful objectives such as freezing capital gains tax on the death of the parent freezor and allowing the use of a family trust to own the new gross shares, which allows flexibility for deciding in the future on future allocation of the gross shares and dividends. So that's still something that will still be useful. In some situations, the the individual, the family member receiving the dividends is already at the top marginal rate, so these restrictions will not be relevant to changing that. A couple of other items that are not of income splitting that are not touched by this are prescribed interest rate loans, which are still currently at 1% reinvested by spouse and children. With that type of planning, there is the requirement to pay annual interest by January 30 each year, unrelated to private corporations, but a common income splitting still available is splitting eligible pension income between spouses. And there's a specific exemption, income earned on property received from a parent on death. They're nice enough not to go after that. In terms of, again, to the extent these new restrictions don't apply until 2008, sort of an obvious item to consider is to maximize dividends to family members by the end of this year, because those dividends will not be subject to the new restrictions. So you'd certainly want to have enough dividends going up to family members to make use of their separate graduated rates. In terms of key takeaways from these changes, assuming these income splitting changes become effective, they're going to have very broad impact basically on all CCPCs. Based on the comments in the press by Trudeau and Morneau, they seem, despite all the opposition, they seem to be taking the position that they're not going to be backing down from these changes. They're giving lip service to listening and maybe tweaking it, but in terms of the income splitting changes, I'm not too optimistic of them making any significant changes to what we've seen. Basically, on a go-forward basis from 2018, these issues are going to have to be considered whenever paying dividends from a private corporation. We're going to be left with the significant uncertainty as to what will be considered by CRA a reasonable amount, and there's unlikely to be much, if any, useful guidance. I guess from a practical point of view, I mean, certainly there's nothing to change people from taking a filing position that the dividend they're paying is reasonable and let CRA challenge it. Again, hopefully based on the track record relating to the reasonableness requirement for salaries, despite all this noise and politics involved, it's conceivable that CRA may not be all that aggressive in challenging the dividends. And there's not a huge downside because unlike the concern about the reasonableness requirements for salaries, where if denied, it results in double tax, at least with the dividends, if CRA successfully challenges it, then you're not going to have a double tax situation. At most, you're going to have that dividend taxed at the top rate. So the downside is not that significant. Again, keeping in mind that most of the tax savings occur at relatively low amount of dividends. So it's not as though you have to be paying super aggressive amount of dividends to be taking advantage of most of the tax benefits. And in terms of the most immediate item that can be done is to consider the most tax efficient amount of dividends to pay out by the end of 2017 before the restrictions come into effect. And do you prefer questions at the end? Yeah, okay. And if you have any questions at the end, I'll be around.
Josh? Do you have any better news for us?
So no, Lorne, I don't have any better news for you. when I first read these changes and read them and reread them and read them again, I was bothered less and less by the tax policy and more by being taken back to first-year philosophy and political science, and just the extreme Marxism that we're seeing in the literature that's coming out. This is class warfare at its worst, and the government led by two of the elites in this country, one man who's never worked an honest day in his life, and one that did and who's turned his back on the professional community, putting the average so-called blue-collar worker that's apparently been downtrodden and beaten down by wealthy professionals and business owners in a war against those business owners. This is really the proletariat versus the bourgeoisie. You could sub in those words throughout the consultation paper, and it would still make perfect sense. And I think we're heading in the wrong direction politically if that's where these are taking us. As Lorne mentioned, I'm going to be speaking about two distinct topics. The first are the changes to the lifetime capital gains exemption, and the second is a much more technical issue, which is the conversion of income to capital into capital gains and some anti-surplus stripping rules that exist and that are new, and that I think may apply in ways that people didn't originally expect them to. Beginning with the lifetime capital gains exemption, this is a nice little incentive to business owners to be able to build up a business in this country, employ people, contribute to the economy, sell their business, and get a little bit of relief from capital gains taxation. It applies to the disposition of so-called qualified small business corporation shares. I won't bore you with the technical analysis behind that. Basically, shares of a private company in Canada that carries on an active business and doesn't have a buildup of redundant passive assets. The current exemption amount is $800,000. It's been indexed to inflation. It was done under the Conservative government. This year it's $835,716, the numbers on the board, and it's been increasing every year with inflation. The capital gains exemption can be claimed by any individual other than a trust. So that's, a human being, basically. But the LCG, the capital gains exemption, has always been accessible via trust. There's a series of rules in the trust taxation area that allows a trust to sell shares, realize a capital gain, allocate that gain to beneficiaries in accordance with the terms of the trust document, and then make some designations under the act that preserves the character of that capital gain so that when it hits the hands of the beneficiaries, it is a taxable capital gain, and it is a taxable capital gain from the disposition of the right kind of property. And then the beneficiaries just report the gain the way they would as if they had sold the shares directly, and they claim their own personal exemption. And this is a very common planning technique, something that I say I'm involved in on a weekly basis in either advising or putting these structures into place. Everybody and their brother does it, and it's no longer going to be available. Why is that? Well, there's an evil here, and that is that the business owner is multiplying the capital gains exemption. And I'll quote right from the consultation paper. Individuals have used these arrangements in a way that permits them to claim the exemption even though they may not have invested in or otherwise contributed to the business value reflected in the capital gains they realize on the disposition of property that is eligible for the exemption. Now, I read the existing rules many, many times. There's no reference in those rules to business value, contributions, working, investing real capital. None of those terms exist. None of those concepts exist. This is all brand new. So notwithstanding that the government thinks that all of this is inappropriate, it's not illegal. And the rules have not just allowed for it, but they've actually facilitated it for years and years. The rules that are in the trust section that allow the flow through of gains are not there for any logical reason. They're not necessary to permit the taxation of trust. They are there to allow trust to do exactly this, to flow gains out to beneficiaries and to allow beneficiaries to claim the exemption on the underlying property, on the understanding, I think, that there's a real reason why people use trust, non-tax reasons, commercial, family planning, asset protection reasons that are legitimate and that are not about multiplying tax benefits and that should be allowed to continue. This government doesn't think so. They're coming at you in three ways on the capital gains exemption. The first is by imposing age limits. The second is by imposing this great reasonableness test that Bill talked about. And the third is just a full-on assault on trust, and I'll talk about each one. So the first is the easiest to understand. If you realize a capital gain and you are under the age of 18, actually, so if you didn't turn 17 in the prior year, this is okay in the year you turn 18, you do not get an exemption. The entire amount of exemption that is available to you is reduced by the entire amount of your capital gain. So it's going to net out to zero. There is no exemption if you realize the gain in a year that you're under 18 years of age. And just in case you thought that you could wait until the next year, sell your shares and realize your exemption, that's not going to happen either. So where you're over 18 years of age and you realize a capital gain on your shares, and if you held those shares before you were 18, you're basically going to have to determine the fair market value of those shares when you turned 18, and only the growth in value beyond your 18th birthday is going to be eligible for the exemption. So anybody who's splitting anything with kids, it's not going to happen anymore. The reasonableness test Bill alluded to a little bit. Basically, capital gains are now being drawn into the taxation of, into this split income, this former kiddie tax. The capital gains were always there to a degree. There was a non-arm's length rule that said you realized the taxable dividend if you had a non-arm's length capital gain. They've taken that out. It's any capital gain. And a capital gain will be split income where it arises from a disposition of property, the income from which would itself be split income. So, I mean, that's pretty easy. You own shares, you're a kid and you own shares of dad's corporation. If you receive dividends on those shares, that would be split income. If you sell your shares and realize a capital gain, that's also going to now be split income. The reasonableness test comes into play in determining, I guess there's this concept of split income versus split portion. You have to have a split portion in order for the split income not to be an excluded amount. It's just definitions on top of definitions. But basically, the split portion is where the reasonableness test comes in. And if you're contributing to the business, you have an invested capital, your realization of a capital gain is not going to be considered reasonable. And then in that case, what's going to happen is if you're over 17 years of age and you've realized a capital gain, the amount that's available for the exemption is going to be reduced by twice the amount of that capital gain. So that's the whole capital gain. So you get no exemption if you did not contribute to the business and if you would be caught by the tax on split income. And just a bit of an explanation from the consultation paper, if you didn't make a so-called reasonable capital contribution to the business, then you're not going to be eligible for the exemption. What's happening to trusts? Well, a number of things are happening. And in very broad terms, any capital gain that accrues during a period in which a trust holds the property, in most cases the shares of the business, will no longer be eligible for the capital gains exemption. And now, you have to keep in mind that trusts themselves cannot actually claim the capital gains exemption. As I spoke about at the beginning, the trust has to realize a gain and go through the machinations of allocating that gain. They're shutting down all of that allocation, and they're doing it in a number of ways. So the first is, you think, okay, I've got this trust that's been holding shares, we've got a sale coming, let's roll out the shares for the beneficiaries. All my beneficiaries are adults. You know, maybe they're even kids that work in the business. That should pass the reasonableness test. Let's get a bunch of exemption. No. If the property is distributed out of a trust on a tax-deferred basis, the portion of the gain that arose while the property was in the trust is not going to be eligible for the gain, for the exemption. So you cannot do this pre-sale. Basically, your entire value at that point would be would be not eligible for the exemption. It's not going to work. You have to, I don't know what you have to do, quite frankly. I don't think you can integrate a trust into your planning anymore and claim the exemption. They've also proposing an amendment to one of the rules that allows for the flow through. So if you think, okay, you know, my trust can realize the gain itself as it always has, and I can allocate this gain out to my beneficiaries and let them claim the exemption. No, they've narrowed the category of trusts that are allowed to make the necessary designations to basically two types of trusts that I'll come to on the next slide here, which are what they call an eligible lifetime capital gains exemption trust. These are basically life interest trusts. So your typical joint partner trust, spousal trust, alter ego trust, trusts that are set up for usually for non-tax reasons and are set up in a tax-deferred manner. And the beneficiaries, these are limited to, you know, one or two people. And the other one is a very limited area of trust that's set up to hold employee stock option shares, where an employer wants to, you know, enrich his employees with stock options, but necessarily doesn't want them to own any of the shares. So in that case, you can set up one of these trusts and allow them to hold the shares. These trusts will still be eligible for the exemption, and that kind of makes sense because the employees are active in the business. Now, if you're in this situation, and I imagine, I know we are to a number of degrees, and I'm sure many of you are as well, there is some relief that's being proposed. You can get some benefit out of your existing structures during the 2018 year, assuming these rules come into force as they're currently proposed. They're allowing an election to sort of crystallize a capital gains exemption for individuals and beneficiaries of trusts. So there's a number of conditions to be eligible for this election. The first is that the taxpayer in question must be an individual or a personal trust. A personal trust is your typical, family trust where nobody has contributed any money to become a beneficiary. So no commercial trust will be captured here, no unit trust, but your regular family trust. There's an election that will have to be made. We haven't seen the election, so I won't just have to comment on what's going to be in it. The property must be eligible property, which I'll come back to in a couple of slides. Where the taxpayer is an individual, it must be reasonable to conclude that the election will result in an increase in amount deductible under the capital gains exemption rules. I'm not exactly sure what the purpose of this is. I think it's to stop you from using this exemption to crystallize other gains that might not have been eligible for the exemption. I'm not 100% sure. This repeats itself again in the trust rules that I'll come to on the next slide. And if the taxpayer is under 18 years of age, the election cannot be made for a share of a corporation. So for some reason, that's still considered evil no matter what. If you've got a kid who's, farm and fishing property is eligible for this exemption as well. Those kids can still claim the exemption. Farmers and fishermen, I guess, are proles and not bourgeoisie. But if you have any minor beneficiaries of your trust, there'll be no crystallization for them. And where the taxpayer is a trust, there's just some other added. Again, we have that reasonableness test. Each beneficiary must be a beneficiary under the trust continuously from the end of 2017 to the date of the election, and I'll come to the significance of the 2017 date in a second. And then again, if the beneficiary is under 18 years of age, the property cannot be a share of a corporation. So what is eligible property? What can we make the election on? Well, it has to be property that's been owned by the taxpayer continuously from the end of 2017. So again, keeping in mind that you're going to make this election sometime during 2018, you have to have held the property at the end of 2017. And that's where we come into that beneficiary since the end of 2017 as well. All of these structures effectively have to be either currently in place or being contemplated to be put in place by the end of this year. The share has to be capital property. That's kind of a precondition in general. And then there's a little bit of relief here, which is that they've changed the references in the definition of qualified small business corporation share for this purpose from 24 months to 12 months. So they're giving your clients a chance to get themselves on side to claim the exemption, make sure the shares are going to qualify, make sure your asset mixes are right. And if you have any issues with a holding period test, you can get into that as well with the 12-month change. What happens with the 2018 election? Well, you're going to be deemed to dispose of the property for proceeds equal to the greater of the amount designated in the election and ACB. So no triggering losses or only triggering gains, but you can basically elect up to any amount you want. I'm sure there's a fair market value cap. The taxpayer will then be deemed to reacquire the property at a cost equal to the deemed proceeds. So you get a step up to your cost base going forward. And all of these new rules that we've talked about, these shutting down trusts and things, none of those rules are going to apply to capital gains and to the claiming of the exemption under this election. So some things to keep in mind about the election. This is the last chance. If you have these structures in place, this is it. There's going to be no opportunity to claim this on an arm's length sale going forward or on a rollout and a freeze or anything like that. This is the end of it. So if it's got to be done, it's got to be done now. And a couple of important planning points to keep in place. And the first, I'm actually going to do the second one first and then come back to the other one. If you're making the election in a trust, you have to be very careful that the trust document actually empowers the trustees with the ability to allocate this phantom income. This is not a real capital gain. This is not a capital gain or an income realization for a trust. There's no fiscal transaction that's happening where the trust is selling property and receiving income. So the trustees, if your trust only gives the trustees the ability to allocate income or gains out of the trust, that's from a trust law perspective. It's not from an income tax law perspective. And this gain will not be income for that purpose. So you need to be reviewing your trust documents and making sure that there's a further power that allows the trustees to allocate this sort of phantom or income tax act income. If that's not there and you do the crystallization in the trust, there's going to be no flow out. No one's going to benefit from it. You're going to be stopped by your trust deed. And so that takes me back to the sort of second bullet point, which is that if you're looking at doing a rollout in order to do this, make sure that you get that rollout done by December 31st. The property has to be in the hands of the beneficiary at the end of the year, or it won't be eligible property. So the first step here is to be reviewing the trust deeds, seeing whether you can do this in the trust, and then seeing whether it actually makes sense to do it in the trust. We have one client situation we're looking at already where we've looked at what the mechanics of that actually would be, and it's not always something that might be commercially palatable. And so if you're going to go the other way and do the rollout, make sure you're getting those rollouts done before the end of the year, or the exemption is going to fall off the table. These changes come into effect beginning with the 2018 taxation year. And just another planning point to note that's not in the slide, if you have clients that are looking at actually selling their businesses with these structures in place sometime in 2018, this is an opportunity where you can utilize the crystallization in front of the sale. Some people have been asking, well, why would I do this anytime before December 31, 2018? What's the point in rushing? I might as well wait, let as much value accrue as possible. Well, if somebody comes along on June and says, I want to buy your business, you're going to want to put this election into place. It should be a pre-closing step if you have these transactions going on. Get the exemption claim, get the election filed, get your step up in basis, and then sell your shares. So we're going to change directions entirely here and talk about the so-called conversion of income into capital gains. This is being targeted in two ways. First, there's an amendment to an existing anti-avoidance rule, and second, there's an introduction of a much broader and more dangerous anti-avoidance rule. The existing rule is section 84.1. I'm sure everybody's heard of it, and I'm sure everybody's heard horror stories about it. I think it was the application of this rule that gave rise to 20 plus years of terrible case law on rectification and tax planning that the Supreme Court of Canada has corrected, in my opinion. Basically, section 84.1 is an anti-surplus stripping rule, and it prevents surplus stripping by limiting the amount that a taxpayer can extract in a non-arm's length transaction to the greater of the paid up capital shares, or so-called hard ACB. And hard ACB up until July 18th was ACB that came from anything other than an exemption claim. So think about the typical situation where people run amok of this rule. Mr. X owns all the shares of OPCO. Mr. X wants to transfer his shares to a holding company. He's going to do it on a tax-deferred basis under Section 85. So he implements his rollover, and his advisors are telling him, well, you know what? You might as well, once you get these shares into holdco, you may never be able to use your exemption. So let's crystallize your exemption now on the rollover. That's a perfectly acceptable planning technique. Mr. X would elect on his rollover an amount to crystallize his capital gains exemption, and then he'd get a step up in his basis. And some advisor says to him, you know what, we're creating a whole bunch of basis. Let's get some value out. Let's extract some boot. Let's take back a note, or let's increase the paid up capital of our shares. We've got real ACB. We can do this. It works under Section 85. Well, it doesn't work under Section 84.1, where you extract boot in a transaction like that. That extraction, which is now basically a cash-free pipeline, a tax-free pipeline of cash for the shareholder, is going to be recharacterized as a dividend. So you lose your capital gains treatment, and you get hit with a nice deemed dividend. Apparently, that rule is not broad enough. The government is concerned about the fact that it's a specific rule that only targets very specific situations, and that people have planned around it. One of the most common examples of planning around it is the pipeline transaction, which I'll talk about throughout this portion of the presentation. And the government notes that it's losing in court, and it doesn't like losing in court. And there's examples of the government, basically throwing a fit when it loses in court. We can think of the Kiwi loan rules that came out of the Shell Canada case, or the insane tax rules that apply to restrictive covenants that came out of the Man-Rail decision. When the government doesn't get its way, it changes the rules. So what's happening to Section 84.1? There's two changes. First, they're changing the definition of hard adjusted cost base to basically include any pre-existing adjusted cost base that did not arise from a taxable transaction or an arm's length transaction. It can be anything. So it can be, you sold your shares in a legitimate cash transaction to your brother, and the shares had ACB on them. That ACB is not going to count. Really, the only ACB that's going to count now is if you bought the shares from a third party. That will be real ACB. Or if you invested real capital in those shares, that will be real ACB. Any other ACB is not going to count. And the other change is that it used to be limited to ACB only from non-arm's length transactions. That's not the case anymore. Again, it's any transaction. So no longer just limited to the capital gains exemption claims, and no longer just limited to non-arm's length transactions. So consider the scope of this. Mr. X passes away holding shares. He realizes a big capital gain on his shares. There's a bunch of ACB in those shares, and then the shares devolve to the estate and to the beneficiaries, which are non-arm's length people. Can I implement a pipeline? I don't know. That ACB may not count. I may not be able to extract my note or increase my puck on my rollover as I normally do to put my pipeline in place, and I may be facing abject double taxation. I've seen the numbers as low as 73% and as high as 93% in one example that's making its rounds around the internet. The pipeline could be dead under this rule. And if it's not dead under the changes to 84.1, it is almost certainly dead under new 246.1. So because 84.1 only applies to very specific types of transactions, And because courts keep telling the government that the Income Tax Act does not contain a policy against surplus stripping, the government has decided to include a policy against surplus stripping directly in the Act. 246.1 has a number of conditions for application, and I'm going to go through these and then I'm going to come back to them at the end because we're going to run through a pipeline and see how this works. But basically the amount has to be, so it applies to an amount, it's going to deem an amount that's received by an individual to be a taxable dividend. So when will it apply? It'll apply when the amount is received or receivable by an individual resident in Canada. Okay. An amount is received or receivable from a person with whom a person, including a corporation, with whom the individual is not dealing at arm's length, so it's non-arm's length transactions. As part of this transaction or the series of transactions, there was either a disposition of property or an increase or reduction in paid up capital. And here comes your beautiful anti-avoidance language. It can reasonably, whatever that means, be considered that one of the purposes of the transaction or series was to effect a significant reduction or disappearance of assets of a private corporation at any time in a manner such that any part of tax otherwise payable by the individual with respect to the portion and in consequence of any distribution of property of the corporation is avoided. So what does that mean? Well, the Department of Finance has given us some guidance on how to interpret the purpose test, and you basically look at the actual distribution and how much tax would be paid on it, and then you look at how much tax the individual would pay if they'd received a taxable dividend. And if the taxable dividend would result in higher tax, then you've fallen into this rule. Where this applies, you get hit with a taxable dividend, so they're going to remove the benefit that you were trying to get in some kind of a tax-free transaction. Thinking of different types of tax-free extractions, you have a return of capital on a paid-up capital extraction. You have repayment of a loan, which is always legally speaking tax-free, and you could have capital dividends. Capital dividends are tax-free distributions that result in less tax than a taxable dividend, and they could be caught by this new rule. And we know that expressly because not only is it a tax-free distribution that would result in less tax, but they've added an additional rule just to sort of kick you when you're down, that if as part of the series of transactions you generated any capital dividend account, that capital dividend account is going to be eliminated. So if you've implemented some type of transactions where you're disposing of assets inside a corporation to generate capital dividend account and then extract that capital dividend account, not only do you not get the tax-free capital dividend, but you lose your capital dividend account altogether. The proposed amendments to these rules are already effective. They took effect on the announcement date. So anybody looking to implement or realize upon any of these types of transactions is basically stopped from doing it while we're in this limbo of knowing what rules are going to come into play. How broad are these rules? Well, again, I think we should go through a pipeline because I think that will really tell you exactly how this would work. So going back to the conditions, so Mr. X owns all the shares of an investment holding company. It's basically just sitting on a very healthy portfolio of marketable securities. He passes away. He had no basis in his shares prior to death. He realizes a large capital gain on death. Tax is paid on the terminal return, and the estate takes the shares with the stepped-up basis. Conventional planning would tell you to implement the pipeline. You incorporate a holding company. You transfer the shares. You don't have to roll them because they have full basis. Transfer the shares of the holding company to the new co. On that transaction, you extract some form of pipeline. So you either take back a note equal to the stepped-up basis, or you increase the paid-up capital of the shares equal to the stepped-up basis. All of that was previously allowed under the former version of 84.1. And then over time, you liquidate the portfolio, you move the money up, or you amalgamate the two companies. There's really no magic to how you do that. And then the CRA has had these weird policies about extracting the money, beginning a year later and over a period of time. And as long as you comply with that, you're okay. But basically, you just started to suck out this surplus on a tax-free basis over time. So if we look at this new rule, we have an amount received or receivable by an individual resident in Canada. Well, the only beneficiaries interested in this are going to be Canadian resident taxpayers. The amount is received or receivable from a person with whom the individual is not dealing at arm's length. The shareholders are going to control the company they get the money out of, so that test is going to be met. As part of the transactions or series of transactions, there was a disposition of property or an increase or reduction in PUC. Well, certainly the transfer of shares of the holding company to the new co is a disposition of property, and there could be a PUC increase as well as part of all of that. So we satisfied that test. Do we satisfy the reasonable, purposes test? We probably do. The extraction of money at the end of the day is going to be on a tax-free basis. That's certainly less than a taxable dividend. And this is really all being done to reduce tax, actually to reduce double tax, which is where we get the nice 93% tax rate now. But I think we're in these rules. So what happens? Well, if I take a repayment of a note or if I extract my paid up capital, I'm getting hit with a taxable dividend now. A taxable dividend that's being derived from assets on which I've already paid a huge amount of capital gains tax at the shareholder level when Mr. X died, and on which I'm probably paying corporate tax to realize upon the assets. So this is a real system now of double taxation. On death, these investment holding companies are going to pose a big problem where there's no sort of basis in there to begin with, the basis that the shareholder had contributed. And you're going to have a situation where the only option really is going to be the 164.6 carryback, which has to be done in the first year, and at least allows you to sort of eliminate some of the double tax by electing to pay the higher dividend tax as opposed to the lower capital gains tax. That's it. Thank you.
Yeah, this is going to be mine next. Yeah. Thank you. Well, thank you, Bill and Josh, for explaining those parts of the new rules. We'll continue with the good news. I'll talk about the taxation of passive investment income in private corporations. I'd like to start with just painting a picture both domestically and internationally, because I think it's important to understand that context. We're looking at a major tax reform that is being put through very quickly, something like 45 days to enable people to comment on it. There's no Carter Commission. There's no major discussion that is being encouraged. This is just being pushed through domestically. Internationally, we're looking at initiatives from the Organization for Economic Development and Cooperation, the OECD, which is saying in order to prevent tax evasion and what they call tax avoidance, we have to have two major thrusts internationally. Transparency, in other words, there's no more bank secrecy. Everything has to be disclosed, including beneficial ownership of corporations, trusts, and so on. So transparency is one thing, and regardless of the damage that might occur to the people whose information is being disclosed, and we'll get into that in a bit later. And the other is the automatic exchange of information internationally. So right now, under Canadian tax treaties, the double tax treaties, or tax information exchange agreements, Canada has over 100 of those combined agreements. There can be exchange of tax information, but under CRS, the Common Reporting Standard, every country that signs on, and there are probably going to be over 100 of them, will have an automatic exchange of information among the various members. So what we're looking at is a completely changed world internationally in terms of the attack against tax planning. So we're looking at both at the same time with major changes to consider. I'm going to talk about, as I said, the passive investment income, the voluntary disclosure program, which up until now has been very successful, is being attacked as being too generous. And then finally, the CRS and automatic exchange of information. So as we've been looking at the policy statements, and as Josh has described it, the class war, here are the statements from the government about passive investments. When private corporations earn income beyond what's needed in their view to reinvest and grow the business, fairness and neutrality require that such corporations not be used as personal savings vehicles for the purpose of gaining a tax advantage. We've had rules in the Income Tax Act for over 40 years that recognize that private corporations are different than individuals, and that when income is earned within the corporations, there are a whole set of rules that are put in place to recognize that. This challenges the existing policy. The use of a private corporation's lower tax rate to invest after-tax proceeds in passive investments results in realization of returns that exceed what individual investors saving in a personal investment can achieve. So there is some kind of comparison here between what happens within a corporation that takes advantage of the lower tax rate and individuals. Is that a fair comparison? The current system with private corporations has a term that's applied to it, to integration, to enable individuals to be looking at an investment and have it, the realization received directly or indirectly through a corporation, and ultimately it's going to be the same tax. So in this example, we see the individual with $100 of salary paying tax at, say, a 50% rate, left with $50 of after-tax income within the corporation, same $100, but here if the low business rate of 15% is paid and the company is left with $85, but then there's a distribution, tax is paid at roughly $35 on the 85, and the total tax paid is $50. So there's a balance between the two on distribution. But until then, that $85 stays within the company. What's the alleged unfair advantage? Here it is. The company is only paying 15%, and so the entrepreneur is way ahead of the salaried individual because the company has $85,000 of after-tax proceeds to start with investing in passive investments. But if an individual has had the same income and paid in Ontario 53.53% at the top marginal rate, that person only has a little over $46,000 to start with to invest. So that's somehow viewed as being an unfair head start that the corporation has gotten. The corporation's owner has to pay personal tax upon dividend distributions, but and I'm quoting here, the strategy of using the corporation to earn past investments provides the owner with a significant tax deferral advantage compared to an employee Canadian, and that is inequitable in the government's view. But there's no strategy. People have just simply followed the rules. They've had the benefit of a low corporate tax rate because the government has given an incentive to grow capital and to employ people, to buy assets and so on. And we'll get into this in a bit, but it's not a strategy to take advantage. It's simply using the existing rules. And the government goes on to say the fact that a private corporation is subject to immediate tax on this passive investment income of about 50%, which roughly equates with the tax on an individual would pay in the same income, does not apparently remove the inequity. So what we're getting at here is, before going into that slide, the Canadian controlled private corporation that gets the benefit of the low business rate has the ability to invest in passive investments, but the government for 40 years has been concerned that we don't want to have such an advantage to invest passively through companies as compared with individuals, so there's a refundable tax that's imposed on the corporation that roughly equates to the 50% rate that an individual would pay. Now, there's a refund that's going to be available when a dividend is paid out of the corporation and the individual pays tax on the dividend. But until then, we're talking about 50% tax in both cases. There's no advantage that the passive investments derive from staying in the corporation. That's not good enough. Here are just some observations about corporate owners using the surplus and thereby distinguishing themselves from individuals. Companies or corporate owners have no employer-provided pension or maternity leave as salaried employees do, no health care or other insurance plan, no safety net. They often have to put away funds as a capital reserve to cushion fluctuations in the business cycle, to cover unforeseen expenses, to act as a security for better financing terms from a bank. And finally, if they want to expand the business, that reserve that they set aside can be very useful. Here's an example of how the current system works with that additional refundable tax that on the payment of the dividend results in roughly a 30% refund to the corporation on an assumed 20% corporate tax, dividend, a non-eligible dividend being taxed at roughly 43%. So in total, as I say, it works out to 50% roughly on both cases. And there is the description of how the corporate tax refund works. And so the government, even looking at that, has said, well, in a particular year where there is a refund, and it's the same year in which there's been this additional tax, it's an excessive benefit as well. And they, again, quoting from the policy statement, preferential tax rates, in other words, the 15% low rate on active business income, were never intended to facilitate passive wealth accumulation, such as through passive investments. So there is a presumption underlying this that, again, there's a strategy here to take advantage improperly of the low business rate for the wealthy to avoid paying tax. The reality is that many businesses use tax savings for proper purposes, but the government goes on to say that maybe what they're really doing is avoiding the personal tax. And this is a loophole. Well, if you look up the definition of a loophole in the dictionary, it would say it's a rule that has ambiguity. It's unclear. And people take advantage of that lack of clarity to the detriment of the public, let's say. But that's not the case here. This was very clear policy for the last 40 years. It's not a loophole. This is a major shift in tax policy to accomplish what the government is saying is social justice. But it really doesn't measure up when you compare, because what they're talking about, the term in tax policy terms, is horizontal equity. If two people are in a similar economic position, they should be subject to similar taxes. So if you've got one person within a corporation and another person is a salary person, and classically, as Bill mentioned, the doctor, the medical profession is up in arms about it. So let's look at a doctor using a private corporation and a nurse being paid a salary. Are they comparable? Are they in a similar position and should be taxed the same? Well, arguably not. The doctor is running a business, incurring all sorts of expenses, not only paying the nurse, but having overhead and having all the obligations that go with running a business, including the risks. The risks assumed, the capital employed, and the effort put in. Whereas the nurse, working very hard, gets paid a salary, has tremendous benefits that could be 30% of the compensation arrangement are paid by the nurse's employer, the hospital or the doctor. Very different circumstances. Horizontal equity does not apply here. So the government is making these changes, and they're saying, we want to impose tax on passive investments, and what are some of the approaches that can be taken? So we don't have draft legislation. All of this, at this point, is a discussion about the evils and what they'd like to do about righting those evils, and what are some approaches that they're talking about. Well, one is they want to preserve the low tax rate, which is actually a very interesting fundamental policy question. Is the low tax rate something that should be preserved? There are some economists, such as Jack Mintz, the well-known professor and speaker, who says that the 15% tax rate on corporations actually acts in a negative way, because companies would otherwise want to expand and grow and become big, but then they'd lose the low business rate. So it contracts Canadian companies to have a low tax rate. We shouldn't do that. We should have, as the UK does, the same tax rate for all corporations. But no, the government isn't even raising that as a question. They're saying, we want to give an incentive to small business and we'll allow the low tax rate to apply. But then they want to get rid of the so-called financial advantages of investing through the private corporation. So they, interestingly, in the discussion paper, have reference to a proposal that was put forward when these rules were brought in after the Carter Commission report and the new Tax Act came in 1972. There was a series of taxes on non-eligible investments that were brought in to discourage passive investments and were found to be too difficult to understand, too difficult to enforce, and unnecessary. The 50% tax rate with the refundable mechanism was found to be adequate. Now, why does the government bring this up, the 72 rules? It's all political. What they're really implying is, we could have brought in those 72 rules again and really hit you hard. We're not going to be that bad. We're going to bring in some rules, but we're going to be much nicer than we could have been. So the way in which this can be looked at is through deferred taxation. As I've mentioned, the corporate tax on passive income is about 50%, of which 30% is refunded when a taxable dividend is paid out. So they're talking about eliminating the refundability of the corporate tax within the private corporation, where earnings are used to fund passive investments that were taxed initially at the low rate. So what does that mean? Every private corporation will have to determine what is the source of the dividend that's coming out. Does it come from income that was earned and taxed at the low rate, or at the high rate, or from capital contributed? It's going to be a nightmare. And here is a comparison of the taxes that would apply under the current system versus the proposed system. And the idea will be that they'd like to have us believe that the denial of the refundability to the corporation is merely putting the doctor in the same position as the nurse. They're both going to be paying roughly the same amount of tax. The reality is going to be different, as we see. So if we are looking at this deferred taxation alternative, all income generated by the passive investments resulting from tax at the lower rate will be treated as non-eligible dividends, so that's at the higher rate. And that is going to be very broadly viewed. So it includes investments in publicly listed securities that now, under the current rules, would be treated as eligible dividends with a higher dividend tax credit and a lower tax. Also, if we have capital gains, the non-taxable portion is going to be considered a passive investment and not credited to the capital dividend account. So if there's no refundable tax on passive investments, how is the corporation's tax treated? Well, first of all, there's this 50% tax, a portion of which used to be refundable. It's not now. So on the distribution, the shareholder getting a non-eligible dividend is going to be taxed at roughly 45%. And so that results in a net of 23% at the individual level. So we've paid 50% at the corporate level, 23% at the individual level, 73% in aggregate. This is punitive. This is a tax grab. This is giving rise, as Bill said earlier, to even concerns within the Liberal Party, because people all over Canada are complaining about this. So a little bit more about the methods they're looking at. There could be two ways of dealing with understanding where the sources of the distributable income come from. One could be an apportionment method. So each year, the corporate owner would look at what's been accumulated, taxed at the low rate, that would give rise to non-eligible dividends. Taxed at the regular general rate, that could give rise to eligible dividends. And if the corporate owner put any capital in as a share subscription, those proceeds, dividends coming out of the earnings from that injection of capital, could be tax-free. How do you keep track of that? And small corporations, small businesses are going to be overwhelmed. How's the CRA going to be able to understand, administer, and enforce these rules? Highly complex, highly difficult, very costly, and ill-advised, to say the least. There is an alternative they're talking about, though. They call this the elective method. So if this is too difficult, what they can do, what a corporation can do, is to have a default tax treatment, which means that the passive income earned in the CCPC will again not have the ability to create refundable taxes, and dividends would be paid as non-eligible dividends. Again, that's a 73% rate. That's the default. But alternatively, the corporation can elect that it will be able to have refundable taxes, get that 30% back, and pay out eligible dividends, but they can't claim the old business rate anymore. That's the trade-off. So the incentive to help small corporations with a low tax rate and build it up would be gone. So in summary, these are complex and costly rules. Small business will be faced with serious burdens. And one of the interesting observations, justification in the policy papers, is that this requirement to distinguish between active business income and passive investment is very clear. It's not going to be a problem. It's quite the opposite. For decades, there have been tax cases litigated over the distinction between these two categories. And sometimes it's very difficult to tell. There are cases where reserves were built up within a corporation, and this happened to be a foreign corporation. The question was, is that surplus passive income subject to the FAPI rules, foreign accrual property income rules? And in one case, those reserves were required because of the foreign business to protect against the risks associated with doing business in the jurisdiction. That was okay. Even though that was passive, it was close enough to the necessity of the business to justify. In another case, it wasn't sufficient. The surplus was viewed as redundant to the actual business. So that it's so fact and circumstance based, it's going to be very uncertain, very difficult to tell the difference between these two things. The government says not a problem. Another negative I would suggest is if an entrepreneur now is looking at what to do with the after-tax amount, let's say again $85 on every 100, if they use those monies to invest in passive investments, they face this huge burden. So instead, why don't we go out and buy a new business and start spending the money? But that's not really very good tax policy. To be driven by a tax consideration to make a business decision is very poor policy. So we're now looking at what may come out as detailed rules. Again, we don't have any sense that there's going to be any grandfathering of existing situations, although the government has repeatedly said that they don't intend to have these new rules on passive investments hit existing structures, it's not at all clear that that's going to be the case. So what's a strategy that we can think about looking at the current situation? Obviously, it's best, if these rules are going to come in, let's trigger the capital gains now, get a credit to the capital dividend account, and try to take advantage of it as we can. Life insurance, you probably read a lot from life insurance brokers now saying, even though the realization of capital gains is being attacked, life insurance proceeds received on death can still go into the capital dividend account. Exempt life insurance policies can be used to shelter investment income, even if owned within a corporation. And then it's possible for the entrepreneur to set up an individual pension plan. Briefly, I mentioned about what might be considered if these rules come in for investment companies to still be able to get the flow-through treatment. So let's move on to, in the last few minutes, the other two areas that I wanted to touch on. A bit of a potpourri, as I say. The voluntary disclosure program permits people who have had what oftentimes undeclared offshore income or excessive expenses to be able to come forward before the tax department comes to them under an audit and to say, sorry, I made a mistake. I didn't declare my foreign income. I want to pay the tax now, become compliant. And if all of that is voluntary, complete, and before the tax department comes to the taxpayer, then that's a windfall. And the government will do very well under this kind of policy. And it has, I'm quoting at the bottom from a report by the Joint Committee of Lawyers and Accountants, which is opposing the changes, saying this program plays an important role in combating tax evasion and achieving compliance because it encourages people to come in from the cold, to become compliant. And we've got to be very careful not to discourage people. And we also have a system today where if a client comes to me, I can approach the department on a no-names basis, say, here are the facts. Will it be compliant, do you think? And if I get a positive answer, then I can move forward. If I get a negative answer, then the taxpayer has to decide what best to do. There will be no more no-names under the policy. This new policy results from a report from what was called the Offshore Compliance Advisory Committee, made up mostly of academics, trying to tighten the system. And it's a shift in policy to a multi-tier system. There's a general system, which will be similar to today, a little more restrictive, but generally like today, and then a limited system. And this limited program will not provide the same kind of relief if one of or more of these factors that I've listed is found. I've underlined one which really bothers me. A sophisticated taxpayer will be denied relief. So somebody has made a mistake, and it could be a parent who made the mistake, and the children inherit this offshore account, and they want to come forward, but the sophisticated parent, who may be dead, taints the whole voluntary disclosure. It makes no sense. Without going into all the detail, I'll just say the most recent statistics that I've seen for 2015 showed a 50% increase in dollars from something like $300 million to $1 billion of voluntary disclosure proceeds that came in as a windfall to the government. And now this program is going to discourage that. Another major policy problem I point out here is no relief is going to be provided for large corporations, ones that have a revenue in excess of $250 million. So where is the equal treatment before the law? Josh and Bill have talked about some distinctions that are drawn in the private company context between people who are over 25 versus between 18 and 25. To me, that's inequitable. Here's another inequity, but it's a target. Last point I'm going to talk about is the Common Reporting Standard. This is the initiative of the OECD. Canada has signed on to it. We have now part of the Income Tax Act, Part 19, which provides for that automatic exchange of information. We've already had it with the United States under the Canada-U.S. Tax Treaty and FATCA, the Foreign Assistance in Offshore Accounts legislation of the U.S., but now it's going to be expanded all around the world. How does it work? A typical Canadian bank with an account held by a non-resident has to report that account to the CRA. CRA will report it to the Foreign Tax Authority. It may be in a corrupt country where the person doesn't want that information exposed because of fears. Well, it doesn't matter. Plus, there is no requirement to notify the account holder of this change, and no opportunity, therefore, for natural justice, for the account holder to say, wait a minute, don't send that account over for ABC reasons, give me a chance. No, there's no chance. There's no notice and no opportunity to be heard. And then I said the final point. This is actually the final point, country by country reporting. This is for large corporations, corporations that have, putting Canadian dollars on this, close to $1 million of revenue in the group. Then there's going to be a requirement, and this is now going to be part of the Income Tax Act as well. It is in 233.8 that there will be an accumulation of reported income of profits, revenue, employees, and so on, of all the affiliates to the parent corporation and the CRA. So the idea here is that multinationals are hiding their income, and this transparency and reporting obligation will ensure that every country in which an affiliate is located gets its fair share. I don't know what they're going to do with all this information. It's going to be overwhelming. And whether it's going to be effective or not is highly questionable. So in summary, we have a serious tax grab that's being occasioned domestically. We've heard about the tax on split income, the denial of the use of family trusts in conventional estate planning, the taxation of passive investments in private corporations is being attacked, and internationally, we're seeing all of this happening at the same time. So there's a lot of pressure being put on tax planning these days. There are still some opportunities, but we have to be very, very cautious. And hopefully everybody here will now be more aware of some of these problems. Let's raise our voices and try to get some of the changes reversed. We will be here for question and answers if you'd like, but we're now past the 9:30 time. We promised to end. So I thank you for your attention for those who are here and on the webinar, and we'll see you at our next session. Thank you very much.